wanted to cover something that's really very useful, especially when you're looking at individual stocks or securities, as well as portfolios. And this is really very helpful when it comes to portfolios because how do you compare one portfolio to another, especially in how they've done when you look at the return, but you also have to look at the risk that was associated with that return. Because going forward, you could have a reversal of that return. You could actually end up being in a negative return situation because of how volatile, of how much variability that portfolio may have had. And this ratio is called the Sharpe ratio. And as you can see from the formula, it's the return of the portfolio minus the risk-free rate. Now, risk-free rate is basically the duration of how long you're looking at for the return. It could be the risk-free rate for 3 months, it could be for a year, and that risk-free rate is really the our interest rates that are dictated by the bonds and the notes that are put out by the and the T-bills that are put out by the our government. And at the bottom, you divide that by the variability, the volatility of that portfolio. And those are, again, to calculate that volatility on the standard deviation of the portfolio. There's a long process to it because not only do you have to look at the variability of each individual security in the portfolio, but also how they co-vary with one another. And that's, again, that gets to be quite involved, especially, as the portfolio grows. But there are ways to do it, obviously. But again, by doing this, what you're getting is how much of return are you getting per each percentage of variability. So my return on the portfolio minus my risk-free rate is, let's say it's 10%, and my standard deviation is roughly 1%. Then for every standard deviation of 1%, or for every variability of 1%, I'm getting a return of 10%. That's pretty good. Now, when you're getting close to that, let's say it's only 1 to 1, then things could change very, very quickly, depending on how the variability plays out. Your return could be a lot less. It actually could vary quite a bit, because of that, how close it is to how much it's moving. Whereas if the return is much greater than compared to the actual variability, then most likely you will continue to get higher returns versus the actual variability of that portfolio. And so again, this is when you're actually looking at individual securities, possibly as well as portfolios, this is really, really important to see how much, a risk essentially is within the portfolio compared to the return that you're getting. Again, measures excess return per unit of risk. Higher Sharpe equals better risk-adjusted return. Again, if the return is much greater than the actual variability of the portfolio, then obviously from a risk-adjusted return basis, it's very good. Again, it's a way to look at return versus volatility, which is really, really important, especially if you not only looking at, again, one portfolio, but especially when you're comparing it to other portfolios. Benefits, again, it's a way to standardize the comparison between portfolios and even across individual securities, actually. And again, it combines return and risk. And by doing it and actually looking at portfolios where you're actually calculating a Sharpe ratio, you can see how efficient, because again, if the returns are much greater than the actual variability, that's a very efficient portfolio. And again, and this is really, we've kind of touched on a couple of the first two, but the last one is really, really important. So if you're somebody that's actually looking for low risk, low volatility, then you're going to want something that has a much higher Sharpe ratio. And so when you're comparing different funds, different portfolios, that's what you're going to be looking for. Whereas if you're more of a risk taker, maybe you're younger, and so you can actually take on the risk, then you may be looking for a Sharpe ratio that may not be that high, and where you want more of the variability because if the variability actually works out in the right way, you're going to get a much higher return, and so that's what you might be looking for. But ultimately, for all of us, we want higher returns compared to low risk. And again, if you can maximize that, optimize that, where you're creating portfolios where you're getting the greatest return for the lowest amount of risk, that's what you want. Ultimately, that's really the best way to really construct. And again, you can that variation between return and volatility, it can change, you can vary that. And so, maybe you want, instead of having a ratio of, let's say, two, maybe you want one of four. A two is still good, but four is much better. And so that's something that you would actually have to do some analysis and construct it so that, again, you may end up also increasing the variability, obviously, but you're also getting a much higher return. So again, great way to compare and also to construct. If you're actually constructing it, again, we'll get into more of this, but if you're actually constructing a portfolio, this is something that you want to look at and calculate. And that's it for this section. Thank you, and we'll talk to you again soon.